Gold just fell more than 25% from its January high. And if you only look at that number, it looks like a disaster. It isn't. It's not even surprising. And by the time I'm done walking you through what's actually happening under the hood, you're going to understand why the drop doesn't change the thesis, it confirms it. Here's what's actually going on, why it's happening, and what it means for your money. Gold hit an all-time high of $5,589 an ounce back on January 28th of this year. Today, gold is trading right around $4,190 to $4,120 an ounce. Do the math, and that's a drop of roughly 27% from the peak. Headlines are calling it a crash. Some guy on financial television is telling you gold broke down and that the gold trade is over. And I get why people panic when they see a chart that goes almost straight down for 5 months. But before you make any decision based on a 5-month window, you need to understand what a bond actually is, why interest rates move markets the way they do, and why the thing driving gold down right now is the exact same thing that's going to eventually drive it right back up. Let's start with the basics, because you can't understand any of this without them. A bond is basically an IOU. You lend money to a government or a company, they promise to pay you back later, plus interest. The interest rate on that IOU is called the yield. Right now, the yield on the 10-year US Treasury bond, basically the government's most important IOU, is sitting around 4.5%. That matters enormously for gold because gold pays you nothing. Zero. You can hold a gold coin for 50 years and it will never once pay you a dividend or an interest payment. So when bond yields go up, suddenly that boring government IOU is paying you 4.5% a year, guaranteed, and gold is just sitting there in a vault doing nothing. Money, being money, chases yield, so it flows out of gold and into bonds. That's rule number 1, and it's the single biggest reason gold has fallen since January. Rule number 2 is the dollar. Gold is priced in dollars worldwide. When the dollar gets stronger, gold, measured in that stronger dollar, automatically looks cheaper, even if nothing else changed. Right now, the dollar index is sitting around 101, up more than 3% over the past year, largely because of safe haven buying tied to the conflict between the US and Iran in the Middle East. Oil prices spiked, inflation fears spiked with them, and ironically, some of that fear money flowed into the dollar instead of gold. That's the first head scratcher of this whole story. Geopolitical fear is supposed to be gold's best friend, and for a few months, the dollar stole its lunch. Reason number 3 is leadership change at the Federal Reserve. Earlier this year, Kevin Warsh took over as Fed chair, replacing Jerome Powell. Now, President Trump has pushed hard for rate cuts, and he trusts Warsh more than he trusted Powell to eventually deliver them. But here's the twist. Even with a Fed chair who's expected to lean toward cutting rates and shrinking the Fed's balance sheet down the road, the near-term expectation from markets is that rates stay elevated, maybe even tick up once more before year-end, because inflation data has been stickier than anyone wanted. So in the short run, you've got a market pricing in higher for longer, which, remember rule number 1, is bad for gold's relative appeal. But, and this is important, a new Fed chair reshaping policy, reconsidering how inflation is even measured, potentially expanding the balance sheet again down the line, is historically one of the biggest tailwinds gold can get. We'll come back to why in a minute. And reason number 4, the one nobody's talking about enough, plain old profit taking. Gold ran from around $3,000 an ounce at the start of last year to $5,589 in January. That's an almost 80% move in about 13 months. Nothing goes up like that forever without people cashing out. ETF investors who bought gold at $3,200 and watched it hit $5,500 did what rational investors do. They took the win. That selling pressure, layered on top of the bond yield story and the dollar story, is what turned a healthy pause into a sharp-looking correction on a chart. Now, here's where I want you to picture something, because numbers on a page don't always land the way a physical image does. Think about a pressure cooker on a stove. You've got heat underneath. That's the actual demand for gold, the real structural long-term forces we're about to get into. And you've got a valve on top that releases steam when the pressure builds up too fast. From January to June, the pressure built up so quickly, 80% in 13 months, that the valve had to blow. Steam came shooting out. That's the correction you're seeing on the chart right now. It looks dramatic, it's loud, it's a little scary if you're standing right next to it. But here's the thing about a pressure cooker. The fire underneath never went out. Nobody turned off the stove. The heat that built that pressure in the first place is still there, still burning. and it's going to start refilling that pot again the moment the steam finishes venting. Keep that pot in mind. We're coming back to it. Now let's actually get into the fire underneath the pot, the stuff that doesn't show up in a 5-month chart, but absolutely shows up over 5 years. Central banks. This is the part almost nobody outside of finance pays attention to, and it's the most important part of the entire story. According to ING's most recent commodities research, central banks added 244 tons of gold to their reserves in just the first quarter of this year, while the price was falling. Read that again. While retail investors and ETF traders were selling into the correction, the institutions that actually run monetary policy for entire countries were buying. That's not a coincidence, and it's not a small detail. Central banks don't trade gold for a quick flip. They buy it because they're thinking in decades, not quarters, and they're positioning for a world where the US dollar isn't the only safe place to park a national reserve. And it's not just buying. Some of the biggest institutions in the world are also restructuring how gold gets traded in the first place. Go back to last year, and you had China's Industrial and Commercial Bank of China, one of the largest banks on the planet, along with the Postal Savings Bank of China, Ping An Bank, and China Guangfa Bank, all shutting down retail paper gold trading for their own citizens, one after another. If you're a retail investor in China trying to trade gold through a bank account rather than hold the physical metal, your access got switched off. At the same time, exchanges raised margin requirements on gold trading to record levels, meaning if you wanted to speculate on gold with borrowed money, you suddenly needed dramatically more collateral to do it. The official reason was investor protection. But look at what's actually happening underneath that explanation. These institutions are pushing people out of paper promises about gold and toward the real thing. When you shut down the casino chips and leave only the actual chips on the table, you're not protecting anyone from volatility. You're changing who's allowed to bet and on what. Now, hold on. You might be thinking, if central banks are buying and gold is still this great hedge, why is my portfolio down? Why did it fall right when I thought I needed protection? That's fair, and it's the most important question in this entire video, so let's actually sit with it instead of rushing past it. Gold was never designed to be a smooth, straight line upward. It was designed to be the asset that holds its value over long stretches of monetary chaos. Decades, not quarters. If gold only ever went up in a perfectly straight line with no corrections, it would mean the market had stopped pricing risk altogether, which would actually be a red flag, not a comfort. A 26% pullback after an 80% run is historically completely normal. What matters isn't whether gold dipped in the summer of 2026. What matters is who was buying that dip and why. And the answer, again, is central banks, sovereign wealth funds, and, quietly, Chinese retail investors who are now funneling money into physical bars and coins instead of paper contracts because the physical stuff is what's left available to them. Let's talk about history for a second, because this exact pattern, sharp correction, panic, gold is dead headlines, followed by a much bigger move later, has happened before, more than once, and it's worth zooming into two specific moments so you can see the shape of it. Go back to August of 1971. Richard Nixon goes on television on a Sunday night and tells the country that the United States is suspending the convertibility of the dollar into gold. For the previous 27 years, under a system set up at Bretton Woods, foreign governments could trade in their dollars for gold at a fixed rate, $35 an ounce, locked in place. But by 1971, the US had printed and spent far more dollars than it actually had gold to back, largely from Vietnam War spending and domestic programs, and other countries started getting nervous, showing up and asking to cash in their dollars for actual gold. Nixon's Treasury Secretary at the time reportedly told him something to the effect of, "If we don't act, we're going to run out of gold." So Nixon closed the gold window. Just like that, the dollar became what's called a fiat currency, meaning its value comes purely from government decree and public trust, not from being tied to a physical asset. In the immediate aftermath, there was confusion, some short-term dollar strength as markets digested the shock, and plenty of people who thought gold's role in the world had just been made irrelevant since it was no longer officially tied to money at all. What actually happened over the following decade was the opposite. Freed from that fixed $35 peg, gold was allowed to float, to actually reflect what people thought money should be worth in a world of expanding currency supply and rising inflation. Within 9 years, gold went from $35 an ounce to over $800. Which brings us to the second parallel, January 1980, when gold hit that era's version of an all-time high, driven by inflation running in the double digits, the Soviet invasion of Afghanistan, and a full-blown crisis of confidence in the dollar. Then Paul Volcker, the Fed chair at the time, did something almost nobody wanted him to do. He jacked interest rates up to nearly 20% to strangle inflation, even though it triggered a brutal recession. Gold, just like it's doing right now, collapsed under the weight of those high rates. It didn't just correct, it fell for years, eventually losing more than half its value, and not reclaiming that 1980 peak, in real terms, for decades. If you were a gold investor in 1981 reading the newspaper, you'd have every reason to think the whole thing was over, that gold had been a fad of the 70s, and the smart money had moved on to stocks for the rest of the century. And on a stock versus gold basis over the following 20 years, that read wasn't even wrong. But notice the mechanism. It was rate policy, specifically, that crushed gold both in 1980 and right now in 2026. Same lever, same reaction. The difference is what happens after the lever gets pulled back, and I want you to hold on to that thought, because we're going to circle back to the pressure cooker. Now let's zoom out to the other side of the ledger, the stock market, because this is where the story gets genuinely strange, and it's a big part of why so much smart money is quietly rotating toward gold, even during this dip. There's a measure called the Buffett Indicator, named after Warren Buffett, who's called it probably the best single measure of where valuations stand at any given moment. It simply compares the total value of the stock market to the size of the entire economy, GDP. As of this month, that ratio is sitting at roughly 235%. To put that in context, there have been exactly 3 moments in the last 70 years where this indicator crossed above 100%, meaning the stock market's value exceeded the entire economy's yearly output. The dot-com bubble peak in the year 2000, the everything bubble peak in late 2021, and right now, except right now, we're not just above 100%, we're more than double it, at a level this indicator has quite literally never reached before in recorded history. In both of those earlier instances, the market dropped somewhere between 25 and 47% from peak to bottom, and it took anywhere from 2 to 13 years to fully recover. We are, by this measure, in genuinely uncharted territory. So let's actually answer the question I promised you at the start. What does this mean for the 3 assets that matter most to your money? Stocks, gold, and the dollar. Stocks right now are priced for perfection in a world that has never once delivered perfection for this long. That doesn't mean a crash happens tomorrow or next month or even this year. Markets can stay expensive for a long time before gravity shows up, but it does mean the cushion for bad news is thin, and the Buffett indicator has an almost perfect track record of eventually being right, even when its timing is frustratingly imprecise. Gold, in the near term, is still fighting the headwind of high bond yields and a firmer dollar, the steam still venting from that pressure cooker. JP Morgan's own research team is projecting gold could average around $6,000 an ounce by the end of this year and touch as high as $6,300 in 2027, precisely because they expect the underlying drivers, central bank accumulation, de-dollarization pressure, eventual rate cuts under a Fed chair who's shown he's willing to break from convention, to reassert themselves once this correction finishes running its course. Other analysts, like the team at ING, have actually trimmed their near-term targets to around $4,300 for the third quarter and $4,600 for the fourth, which tells you the disagreement isn't about direction. Almost nobody thinks gold's structural story is broken. It's about how choppy the next couple of quarters look before the next leg starts. And the dollar? The dollar's strength right now is largely a fear trade tied to a live conflict in the Middle East. And fear trades, by their nature, are temporary. The moment that geopolitical premium fades, or the moment Kevin Warsh's Fed actually starts cutting rates the way markets increasingly expect over the next year, that dollar strength is one of the first things likely to unwind. And when it does, that's usually gold's cue. So let me tie this all together, because I think it's easy to get lost in 8 different data points and lose the actual thread. Gold fell 26% from its January peak because bond yields rose, the dollar strengthened on Middle East fear, a new Fed chair created near-term uncertainty about the pace of rate cuts, and investors who'd made an 80% profit in 13 months did what profitable investors do. That's the steam escaping the pressure cooker. But the fire underneath that pot, central banks buying 244 tons in a single quarter while everyone else panicked, China restructuring its entire retail gold market to push people toward physical ownership, a stock market sitting at a valuation level history has genuinely never seen before, and a monetary framework that's been leaning on more debt and more currency creation since Nixon closed that gold window in 1971. None of that turned off. Twice before, in 1971 and in 1980, gold went through a moment that looked like the end of the story, driven by the exact same lever, interest rate policy, that's driving this correction today. Both times, the story wasn't ending, it was pausing. Here's what I'd say to you today, on the record, with numbers I can actually back up. Nobody knows if gold bottoms at $4,000 or dips toward $3,800 before turning, or has already found its floor around $4,100. Anyone who tells you they know the exact number is guessing, and you should be skeptical of anyone selling you certainty in a market this dynamic. What I can tell you with real conviction is that the forces pushing institutions, central banks, and entire national banking systems toward gold have not gone anywhere. They're still buying, they're still restructuring, they're still positioning. The question isn't whether gold still works. The question is whether you're paying attention to what the people who actually run the system are doing with their own money right now, while the headlines are telling you it's over. If any of this is hitting close to home, if you've got a decent chunk of your retirement sitting entirely in stocks and cash, while the Buffett indicator sits at a level it's never touched before in history, it's worth actually sitting down and looking at whether your savings are built to handle a correction, like the one that hit gold this year, except in the assets you're actually holding. I put together a free guide that walks through exactly how people are protecting retirement savings against this kind of volatility, without needing to predict a single headline correctly. It's linked below this video, or you can just scan the QR code on your screen right now to grab it. Doesn't cost you anything, just information. Okay, anyway, back to it. Because here's the thing that ties every piece of this together. Every one of those historical moments, 1971, 1980, even 2008, looked in real time like chaos with no clear resolution. It's only with the benefit of hindsight that the pattern becomes obvious. Rates rise, hard assets get squeezed, panic headlines spread, and then policy eventually gives, because governments with enormous debt loads have a long, consistent history of preferring inflation and currency depreciation over the alternative, which is austerity nobody in power actually wants to impose. That's not a conspiracy theory. That's just what happens when you owe more than you can comfortably pay back in today's dollars. You find ways to pay it back in cheaper future dollars instead. Gold has been the asset that holds up when that happens, going back centuries. Not because of some mystical property, but because you cannot print more of it. There's no button any central bank on earth can press to create another ounce of gold. That scarcity is the entire reason it existed as money for over 5,000 years before anyone thought to try a purely paper alternative. So when you see a headline that says gold crashed 26%, I'd encourage you to ask the follow-up question nobody in the headline bothered to ask. Crashed relative to what? And who was on the other side of that trade buying it up while it happened? In this case, the answer is central banks holding more gold than they've held in decades. Banks in the world's second largest economy restructuring how their own citizens are even allowed to access it. And a stock market valuation that has left every historical precedent in the dust. That's not a market falling apart. That's a market repricing risk in the short term, while long-term structural buyers accumulate in the background. Exactly like it did in the years after 1971. And exactly like it eventually did again after 1980, once the rate hiking cycle that caused the pain finally ran its course. Before you go, I do want to mention one more thing, because I think it matters more than almost anything else in this video for a specific group of you watching. If you've got $100,000 or more sitting in a retirement account, a 401k, an IRA, anything like that, and you want to actually sit down with someone and walk through what a properly diversified retirement strategy looks like in a year where gold swung 80% up and 26% down inside 18 months, we're running a free one-on-one educational web conference specifically for people in that position. No sales pressure, no obligation, just a straightforward conversation about what protecting a retirement account against this kind of volatility can actually look like. Details are with that same guide I mentioned, link below or the QR code on screen. All right, let's get back to it. Because if there's one lesson worth taking away from every single data point we covered today, it's this. The loudest headline is rarely the most useful signal. The useful signal is what the people who move billions of dollars and who don't have the luxury of panicking on a 5-month chart are actually doing with their own balance sheets. And right now, from Beijing to Zurich to the vaults underneath the Federal Reserve itself, that signal is remarkably consistent. They're accumulating the one asset nobody can print more of during the exact window when everyone else is convinced it's done. So gold just dropped 26% from an all-time high. Real number, no exaggeration needed. Here's why it doesn't matter the way the headlines want you to think it does. Because the fire underneath the pot never went out. The historical playbook from 1971 and 1980 says corrections like this are exactly when the smart money loads up. And a stock market sitting at a valuation level with zero historical precedent means the case for genuine diversification has never been stronger, not weaker. Don't let a 5-month chart make a decades-long decision for you. That's it for today. Go grab that free guide if any of this hit home, and take a real look at how your own retirement savings are positioned going into the rest of this year. I hope you have a wonderful rest of your day, and I'll see you in the next one.